You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
The foremost dangerous words in the English language are this time it's different. In our sector, it's never different. And so there's very, very predictable corporate behavior and investment behavior. It's trying to have a layer of objectivity to understand where you are in that cycle and then invest accordingly. And so when you start to see, I would call it low risk M&A, that's normally the sign that you're at the beginning of a sustained movement in underlying commodity price, and obviously those equities tend to follow that movement of the underlying equity price. So seeing companies take out other producing companies and companies of size, that's normally the green shoots. And so I think that's a very, very positive signal.
Hi guys, this is Brian Lenny of Mining Stock Education and JuniorStockReview.com. Today with me, I have Nicole Adshead-Bell of Cupel Advisory. Nicole, welcome to the show. I think it's best if we start off with an introduction to yourself and Cupel.
Oh, well, there's nothing I like talking about more than myself. So here we go. So geologist originally. You can probably tell from the accent, I came from Australia, been in Canada for approximately 22 years, and then turned to the dark side. So after finishing a PhD in Oz, worked in Canada for a junior, learned what it's like working for a junior from in the trenches, so to speak. And then moved to the buy side. So was working for a precious metals, SEC registered precious metals fund that really had a very global view of precious metals and had the luxury of really being paid to go around the world and educate myself about precious metals company and kicking tires on assets because we did an exceptional amount of due diligence. And then I turned to the darker side. I started went to the sell side at the beginning of the bull market in all commodities. So when copper went from 90 cents to its last run up from 2005 to 2007, covered uranium as well from when nobody could spell it to when it went to plus $120. And so that was this incredible experience of a 2-year bull market, a crazy bull market. And then moved to the darker side again, became an investment banker for 4 years and really focused on M&A leading up and through the GFC. So it was a very interesting thing to go through, talking about political risk and global financial risk, and advised Sherwood when they merged with Capstone, Lundin when they took over in ASEA. So I did some pretty big M&A transactions. Went back to the buy side, to the fake love on the buy side, and then left that and have my own company that I focus really mostly on investing in the resources space. I only invest, I follow Warren Buffett's rules. I invest in what I know for positives and for negatives, and then do some advisory work, I suppose, on the side. It's if companies come to me, whether it's a debt fund that wants some help managing their due diligence process because I'm technical with a financial overlay. I suppose a diverse set of experiences, jack of all trades, master of none, and but really heavily focused on being an active investor and trying to take, I suppose, these learnings from getting paid to be an investor, from being an investment banker, from being a sell-side analyst, and plus 25, 26 years in this industry, trying to put them to work.
Over the last year, we've seen a number of deals in the sector. BHP acquired Oz Minerals, Rio Tinto, and Turquoise Hill. Just lately, we had the proposed deal from Glencore to take over Teck. These are mega deals at the senior level of the resource sector. As a resource sector investor, what does this tell you about where we are in the market?
There's something that I always try and look at, because where you are in the cycle really dictates the underlying performance of the equities. As we know, the equities tend to move to beta. It's very hard to predict and understand the potential for alpha, so those events that are outside the movement to the commodity price. And there's I advise everybody look at it. I talk about it, and there's some stuff on YouTube, but Lion Mining Select have this mining clock. And I've taken that concept and adapted it for myself. And what it does is it gives you a discipline in trying to understand where you are in the cycle. Because we behave, the foremost dangerous words in the English language are this time it's different. In our sector, it's never different. And so there's very, very predictable corporate behavior and investment behavior. It's trying to have a layer of objectivity to understand where you are in that cycle and then invest accordingly. And so when you start to see, I would call it low risk M&A, that's normally the sign that you're at the beginning of a sustained movement in underlying commodity price, and obviously those equities tend to follow that movement of the underlying equity price. So seeing companies take out other producing companies and companies of size, that's normally the green shoots. And so I think that's a very, very positive signal. I mean, personally, I've drunk the Kool-Aid on copper. I'm a pretty big copper bull. And so what we've seen a number of sizable transactions. We've seen BHP with Oz, obviously Glencore are trying to take out Deck. We'll see how that goes. And I think fascinatingly, we've seen Hudbay with its Copper Mountain announcement of that transaction. Now, Copper Mountain, it's a producer, so theoretically lower risk than a developer, but it is a very high cost producer, and it tends to be a swing, has incredible beta and leverage to movement in underlying commodity price. And so for Hudbay, I would say it's on the high risk side of M&A transactions. And to me, again, it's a very, very positive sign. That means that they are taking a constructive view on copper. And that view is that the copper price is at the very least maintaining these levels, but if not going higher. So I think that we're seeing a lot of green shoots. Obviously, Lundin's doing some consolidation efforts in Chile that are part of a strategic consolidation of projects. We haven't yet seen the frenzy of M&A in the development space. Normally, when you see higher risk M&A start, that's more at the top. I think at the top of the cycle, or more of the waning stages of a cycle. So I would say that we're at the beginnings. For me personally, I think copper's. I've said it publicly. I said it last year. I think copper's going to $6 to $8. So I want to be exposed to that.
Oh, absolutely. Recession fears, banking crisis, the threat of world war. There's a number of reasons to be fearful in the market, or sources of risk. In your view, do these risks affect the M&A market? Do we see that, change anything moving forward?
Well, it hasn't really. We are seeing big transactions occur. And so to some degree, when an initial event happens, I think there's an overt emotional reaction, and then it stabilizes. And obviously when Russia invaded Ukraine, it was on the news constantly. There was a lot of talk and rhetoric about it, and it's just faded into the background. Having said that, if there's a nuclear event, I think we'll be more worried about food scarcity and possibly having some gun, things like that, than commodity prices. So look, that's an exogenous event, and I don't think any of us can predict. I think that what Russia invading Ukraine has shown, and really in a horrific light, because there's been many people impacted, is how exposed we are to security of supply and resources, and whether that's metals or food production. Obviously, Ukraine is it's really the breadbasket of Europe and the Middle East in terms of the grain production that comes out of there. I think it really hit home to people that commodities matter. And in our universe, we're very guilty in the mining industry. We talk to each other, we get confirmation bias from each other, but it really matters what the general investor thinks and what the general community thinks. And mining is not well understood, and I think that's largely a fault of our sector. We're not very good at messaging it well. And it's also in some ways loathed because people don't really know where their stuff comes from. And so I think what that event has made people wake up and take notice and go, okay, metals matter, security of supply matters. We need to be thinking of these commodities as the engine of our society and the engine of growth, but they don't get valued that way or treated that way by investors. And I think what we would like to see is that change, the attitude change, a realization that without material investment in many commodities, without a sustained price rise in those underlying commodities to incentivize that investment, the world doesn't look like a very good place in the next 5 to 10 years.
Right. Well, if you were to rank, all those inputs that lead to an acquisition or a merger, where does jurisdiction rank? Because more and more these things seem to be centered in different parts of the world, and a lot of these deals, especially in the short term, have been maybe North American focused, or what I would say is maybe safer jurisdictions. So where do you think it ranks?
Jurisdiction will always come into it. I think sometimes there's a misunderstanding of jurisdictional risk. The US is one of the hardest places in the world to get permitted. It's very, very location dependent. And you had the US government on the one hand come out and say, we support the development of critical minerals, yet and I think it was probably pretty unforeseen, but with Twin Metals come out and change federal land status to preclude the development of Antofagasta's Twin Metals, and then their actions that they took with Pebble. And so I think as a company looks outwards, we have this bias, maybe an Anglophone bias to North America and Australia, and we think it's lower risk, but it isn't. There's a lot of environmental permitting risk. Australia, for instance, is very challenged by security of supply on water. Power is high cost. Power is 55% in Australia, for example, coal-fired. A lot of people don't realise that. And so I think it's very, very jurisdiction specific. And I think the smart companies, what they want to see is security of ownership, and then go and what they don't want to see is governments changing the goalposts. But every country is guilty of changing the goalposts. I mean, we've seen it in first world countries, we've seen it in developing countries, we've seen it around the world. So there is no jurisdiction without risk. That was perhaps a long-winded way of saying that.
I completely agree. James Grant famously says, risk is most threatening when it's least obvious and least threatening when it's most obvious. In your view, where do we stand on the spectrum of risk right now? Is it obvious and therefore least threatening?
I think everyone's aware of the big risks. Obviously, you've got global conflicts. I'm not sure that's ever going to go away. Humanity doesn't seem to learn the lessons of the past. I'm not sure what that says about us. We've got this overlaying the financial risk with what's going on in the States and with some of the issues around banking. I actually think that's positive for commodities because hard assets, where do you put your money? I think if the average person really understood what a fiat currency is, what that actually means in terms of the lack of security. What happens if you have $1 million in a bank and that bank ceases to exist and your government maybe backstops for a maximum of 200,000? That's gone. And so how do you protect wealth in this environment of money printing, of massive inflation, et cetera, et cetera? Hard assets is a way to do that. So I think there's this global uncertainty, the monetary uncertainty. I think we're in this unique time where commodity prices have to rise to incentivize new production. We are not seeing high risk capital go into our sector, which is the build capital. The only way that changes is if the commodity prices change. And we saw that with lithium. I mean, you had this massive run up in lithium price. And obviously, if you have lithium in your name, you're probably up plus 100% no matter what your asset base is. So there's a lot of ambulance chasing going on around there, but it did what it was supposed to do. That massive increase in lithium prices incentivized material new production coming online. And I would argue that you need to see that in copper and you need to see that in some of these other commodities. And so we will never live in a world without risk. We are very integrated. I think we're seeing maybe not resource nationalism, but awareness at a government level that security of resources matter. But I think them being aware of that and that resulting in true change in terms of being able to bring on supply more quickly, I think those are two very different things.
Definitely. A lot of these are external risks, whether it's the banking crisis or war. These are a lot of things that investors can't control.
No.
For all intents and purposes, does it make more sense then for the average investor out there to look at what they can do, the stuff they can control themselves? And if they can, where do you think the investor should look?
I think you can control, obviously, buying, selling. I think that we're all very, very guilty of buying and not selling. So I think being aware of when you make a purchase for you, what that exit is and understand what the triggers for that. And educating yourself. You're in control of educating yourself and monitoring your investments. And I have been as guilty as this as probably the average person. And I held a stock many years ago that went all the way to zero, went bankrupt. And that was because I wasn't watching it. And, I'm a supposed knowledgeable person about this sector. And so tracking and monitoring and trying to be objective. And I think one of the unique things about mining is, particularly on the junior side, management teams are very accessible. So you can ring up a CEO and have a chat or speak to their VPIR or see their presentations, such as what you do or with other forums or on YouTube. So there's this incredible plethora of information out there, perhaps maybe too much. And so I think the challenge that one has is how do you distill when there's literally plus 2,000 juniors that are investable around the world, for example, publicly listed entities. How do you distill and how do you try and focus on those that give you the potential for more upside than downside? I think that's the challenge.
Right. And would you, it's often spoken of as noise and signal. Is that what you're trying to convey?
Yeah, look, it's always going to be noisy. I would say that this is a very technical business with a technical language, and most investors aren't technical. And so you sometimes maybe there's and as a technical person, and you'll get this feedback from all people who are technical, sometimes we get frustrated because we look at an asset and go, it's never going to work. It's a very, very bad asset, but it has the right people, the right promotion. The stock can do very, very well. And so I think being aware that a good project can be very different from a good share price performer. And again, it's about an exit. Being exposed to those companies that are wonderful on the promotion side, you can make a lot of money, but you have to get out. And you've got to be aware that a lot of the insiders doing that promotion are probably there at a cheaper price than you and have a better understanding of when their exit point is. And so I think that taking a view on a commodity, obviously, if you think copper's going up, you don't have to be that smart or particular about what you invest in. Everything that's exposed to copper will move upwards. We saw that with lithium. We've seen that with uranium. We've seen that with gold. So I think the hardest thing is being exposed to those companies or trying to determine those companies that their share price will move above and beyond what's happening with the underlying commodity. I mean, if the if gold price goes down, most gold companies are going down unless they've got spectacular drilling success. So it's, and being aware of those companies with those alpha events, that's much more challenge, but sometimes there's opportunities. So for example, Reunion, when they first had success on their project in Guyana, the share price didn't really move. It was like the market didn't realize it. So you had this 3-month window where you could accumulate a position and then everybody became aware of it. And so it's kind of maybe being aware of those people out there that are investing in things not because they're getting paid to talk about it, but are putting their own money in, and that you are confident of taking a reasoned view and understand what they're doing. And again, just feeding into your own information base and understanding what everybody's incentives are. So if someone's talking about something that, in a positive way, they probably own it, or they might be getting paid to promote it. So just understanding incentives, I think, helps de-risk how you invest as well.
For you, when you're deploying money into the market, do you start by looking at a metal and forming a thesis of where you think that metal price is going to go, or?
Yes. Yeah. I am a long-term gold bull. I think everybody is to some degree who's in mining, and I've spent a lot of time working for a precious metals fund. And so I understand that universe, I think, quite well, and have met with hundreds of management teams over the years and kicked the tires and lots of assets. So I have I think, a well-rounded information base that I can draw from when I make those investments. I would say the one thing I did learn about working for a fund for many years, back to our point about selling, was you have to sell. And so maybe the best example was that when I resigned from the fund in mid-2015, I mean, that was the nadir of the bear market. I mean, everybody was, gold's never going to go up. We hate the sector. That was selling with irrationally selling. And for me, I didn't predict 2016. Nobody did, in my opinion. But the sentiment was so negative that you knew that at some point in the next 2 years, that sentiment would change. And all I had to do was be exposed. And so that thesis, I think gold's going to go up in the next 2 years. I want to be exposed to companies that have got leverage beta, so big ounces in the ground, but a balance sheet to survive the next 2 to 3 years. So they're not going to come to the market. And I invested in a bunch of those companies. They did exceptionally well. And then I was out of them by mid-2016 because they went parabolic. And so I had a thesis, and then I tried to have discipline to maintain to that thesis. And I suppose and then now with gold, I pick and choose. So I pick stocks that I go, okay, I like what the management team is doing. I'm taking a positive view on gold. I tend to not invest in very, very early stage exploration companies, maybe because I'm a geologist. I'm too aware of the risk. So I like there to be some information that indicates that there's something there, or that there's the potential for something to be there. I suppose the two key commodities that I'm focused on right now would be gold and copper.
Okay. So if you're going to take the view that you like a certain metal and you're bullish on that thesis, and like you said, negative sentiment gets to the point where you're thinking, oh, you know what, in the next 2 to 3 years, this price has to go up. So is the key, if you're going to bet on the metal price, is the key to have a longer term outlook to be right?
Yeah, look, if you're worried about risk or a 10% downdraft in your position, you shouldn't be investing in this sector, because you'll probably have a heart attack in the next 2 to 3 years. It is a very, very high risk sector. So I think you have to be comfortable with that. You have to be comfortable. And sometimes if something moves down 10, 20%, that could be a wonderful buying opportunity. But it's also stepping back. Sometimes it's also being honest with yourself and going, okay, I bought company X and I bought it for this reason. And I think it's very good to write down the reasons, because we're very guilty of retro-rationalizing in our sector. And so if you bought it for X, Y, Z and it doesn't do X, Y, Z, and then you go, okay, my investment thesis hasn't worked out, I don't see any room for upside. Even if I'm down 20%, I will sell. So I also take money off the table when it's a losing proposition, because it's better to be down 20% than it is to be down 80%. And I've learned that lesson the hard way. And so I think it's, your stocks are individual. You have to understand why you're buying something and then why you sell it. And sometimes share prices will move for things completely unrelated as to why you bought it. And that's a gift. I mean, and so you've got to also go, well, I'm actually not the smartest person in the room. Something exogenous happened, and take advantage of that. And so I think it's being somewhat selective. Don't own 100 names as an individual. There's no way you can keep track of them. And be okay selling, be okay getting out and coming back in. And obviously that might depend on your jurisdiction. If you're in the States, there's tax consequences to that, less so in Canada.
Right. In my view, equity valuations haven't kept up with metal prices. Arguably the best example is gold today. The metal price is over $2,000 an ounce, yet most of the equities continue to kind of move sideways. In your view, what's keeping investors out of the stock market?
I don't think anybody believes that this is sustainable. It's the only legitimate response. But therein lies the opportunity. Gold tends to do well in look, causation correlation with gold. Everybody thinks they understand why gold price moves. I don't actually think any of us do. I think in times of uncertainty and risk, it's a good platform for gold. I think as people better understand fixed asset risk versus paper money risk, I think that really what the gold industry should be doing is making gold attractive to younger people. And we've done a very, very poor job of doing that. Back to the messaging of our sector, we and it's great why you're doing this, is we need younger people messaging to a younger audience. And if you go to the average conference that's aimed at retail investors, there's not that many 20, 30-year-olds in the room. There's an awful lot of grey hair. And so I think gold right now, I think it's an interesting, we've got a great price. I mean, who would think that would be kind of complaining about, $2,000 gold? But that means you have time. You have time to sit back and go, if I'm taking a positive view on gold, what do I want to be exposed to? And the longer this gold price remains at this level or starts to tick up, the more comfortable investors will get. And I think what you tend to see in all sectors, not just ours, it's like everybody wakes up one day and goes, I have to own this. And there's a massive rush. And so we're very, very guilty of being sheep-like. It's very hard to stand out from the crowd, either as a retail investor or an institutional investor or as a corporate. But there's an awful lot of not great gold projects out there. So you kind of need to be aware of, I think there'll be M&A at this point in time across all commodities, given with ETFs and institutional investors and their size growth. There's an argument to do an M&A now just for the sake of getting bigger, because there's more liquidity, you're able to attract a greater number of investors. And so again, what you tend to see is, and the same thing will happen in gold, and we've been seeing this to some degree, is you'll see gold companies, and we've seen a lot of this over the last 4 to 5 years, of gold companies acquiring other producers. And we see themes in M&A. So for a while there, every single Australian company seemed to want an asset or a company in North America. Yeah, I think what happens is one company does something and boards and management teams of another company go, well, they did that, so we should do that too. So there's a lot of groupthink that goes on at the corporate level. And if you understand and appreciate that as an investor, you can make money out of that. They're very, very, if I was a large diversified copper company right now, I'd be acquiring every single development asset out there. I'd be going and offering 100% premium. If you're offering above present transaction premium, boards and management teams have to take it to their shareholders. You could wrap up the development copper space for, I don't know, $2.5 billion probably, and that's future. That is your future supply, and they won't do that. They'll do that after everything's run up 3, 4, 5, 6 times. So, I mean, sometimes I struggle to understand the mindset management teams. It's crazy. You have this, there's a structural looming shortfall. Everybody agrees on that. It's the weirdest thing. Everybody agrees that copper production starts to decline material from 2025. And copper is the baseline industrial metal. If you love lithium, you should really, really love copper. And unlike lithium, there's an awful lot of lithium in the world. There was a lot of known deposits. You could bring it on quickly. That's not the case with copper. So it's weird to me that we're all aware of this looming supply side issue, but people aren't acting yet. But that's also a fantastic opportunity.
In terms of copper, we have this, or I don't even know if you want to call it a recession. I don't know what they consider the market these days in the States or Canada or wherever. But could a recession be a negative to the copper bull or a delay to the copper bull?
Yeah, of course. And I think people are very short-term focused. I mean, the dichotomy of the mining industry and the investing industry is a mining company has to manage its business for plus 10 years. And investors, if you're lucky, have a quarterly time horizon. So how do you do that when your asset base is constantly depleting? Just to maintain your production profile, you have to be growing. So I think that is a challenge. I think that recessions are generally not multi-year in nature. It's a short-term hit. It doesn't change the fundamental dynamics of what's going to happen with supply in the next 3 to 4 years. And you cannot bring on a new mine in 3 to 4 years. Even if a sizable copper mine, if you had fully permitted today, construction funding in place, water, because obviously that's always the key thematic, you're looking, maybe you could have first production coming online in 2025. So we're kind of focused on the downsides to copper and not focused, there's an upside thesis too. And you'll never pick the bottom or the top. None of us ever will. Anybody who says they are is basically lying. It's okay, I'm taking a positive viewpoint and I'm okay with a downdraft. I'm okay with 10, 20% down, because when it talks, it will talk harder and faster probably than any of us predict. And everybody will decide, they'll wake up. What will happen is everybody will decide they'll wake up one day and decide they want to own copper.
Right. So what do you think is the biggest risk to the copper bull thesis?
I struggle to come up with one other than nuclear event. And believe me, I'm not advocating for that. I just don't see anything changing on the supply side. And this is a supply side equation. And mining isn't exposed to the normal laws of supply and demand. There's an inelastic response to price pressure. And again, we're seeing it. We're seeing this schizophrenic behavior of governments, the US case in point. On the one hand, saying we want to see new critical mineral supply, and then on the other hand, stopping it. So I don't see, but that plays across multiple commodities. That's not just copper. And gold's a little bit more of a tougher one, because on the ESG thematic, I would argue we spend way too much time unhelpfully, and a huge amount of money is wasted on ESG. But nonetheless, it's something that has to be discussed and talked about. And there's obviously ESG funds. With almost all commodities, there's an ESG thematic that you can wrap around that. That's a little bit tougher with gold. You can talk about the social side and the governance side, et cetera. But obviously the industrial utility of gold is, we don't need as much gold as we've been mining, but it's there for other purposes.
Right. Which I think are very important. And, it's so often the general public doesn't seem to get it. But unfortunately, I think they will in the coming years, which, we'll see how that goes. So you talked about in 2015, the sentiment in the gold market being terrible. And, you had the foresight to see, this market has to change because, values have gotten so low, and, the outlook of what's going on in the world, you see a bullish future for gold. In that sense, would you consider yourself a value investor? Are you looking for situations where sentiment is terrible, valuations are low, and then that's where you're looking to deploy capital?
I would say I'm naturally a deep value investor, but the problem is, being a deep value investor, you need a management team that's capable of extracting value from the asset base. And so the value traps, I think we've all fallen for them, but to some degree, there's a real opportunity there as well. And and I've talked to some of my peers about that, is it requires effort, but some of these deep value, and there's some incredibly deep valued stories out there, but they're never going to, that value will never be realized unless the management team and board changes. So in some ways, I mean, that's very interesting from an M&A thematic, but it's also as an investor, if a number of, in some of these smaller companies, you could do that, right? If a number of investors went, okay, we think there's deeply embedded value in this project, it's a high quality project, the management team are unable to execute, they're unable to promote, they're unable to tell the story, whatever the reason is, but we're going to come in and fix that. So deep value, if you're investing in a deep value story, you have to have a good understanding that there's an exogenous event that's going to extract that value. And to me, that's a difficult one, because it can be very frustrating. You go, it's so cheap. Why doesn't anybody else realize? But sometimes that can be a Rick Rule talking about it, or an influencer in our sector that people follow and listen to and go, yeah, I agree with you. And sometimes you can have a management team that's very technically good. They've got a great project. They're just not very good at telling the story. That's a great thing to be involved in, as long as they become better at being able to tell the story, or someone tells the story better than they do for them.
Right, absolutely. Personally, one of the biggest lessons that I've learned the hard way is the importance of selling. And you've touched on this a number of different times, but I'd like to rehash that. And so in your view, is the sell price as important as the buy price?
More important.
Okay.
In my opinion, you hear so many stories in the last bull market in all commodities, how people were worth millions and millions of dollars on paper and they rode it the whole way down. I mean, their portfolio was down 90, 95, 99%. You don't want to ever be in that position. And so again, to have that discipline of taking money off the table, if you've got a stock that's moved up 200% in a couple of weeks, don't be greedy. And some of us, you can be exposed to that. And so the example I reference, those stocks as a basket have moved up 300% in under 6 months. I mean, that was a gift. It didn't make any sense. It moved too hard and too fast. And so I exited. So I think you always, every time you buy something, you need to be thinking about what's the trigger for you to sell. And some companies, on the subject of copper, some companies, that might have other things. They might have a wonderful dividend, so you get the exposure to the underlying commodity price, but then you get a great dividend, and that might change your reaction to it. But in the junior sector, generally, they're not producing, obviously. There's a lot of risk. You always need to be thinking about selling, 100%.
I read a great quote from Travis Walton. He's the author of Fire in the Sky, and it's regarding human behavior. He said, I've come to realize that the biggest problem anywhere in the world is that people's perceptions of reality are compulsively filtered through a screening mesh of what they want and do not want to be true. In regards to the investing world, would you agree with Walton's observation?
100%. Confirmation bias. We as humans, we are deeply irrational. We're highly emotional. We're not objective about our own behavior, or I think the world in general. And so trying to step back and instill a layer of objectivity, it's a very, very healthy thing to do, but it's very, very difficult. And so what you see, and you see it with really smart people, you see it with world-renowned investors. Okay, they say, oh, I might like copper. And then they send you every single positive article on copper and never send you the counter argument. So, and in this world we live in, and with the algorithms on whatever media that you're using to access information on the internet, you tend to get fed stuff that you want to hear as well. And so, it's very dangerous. And we're seeing that playing out in this division of political ideologies that's happening, particularly in the West, but it also plays into our sector. So being willing to hear the counter argument and really go, okay, if I'm taking a long position on copper, what are the things that can curtail that? And having that debate, if not with yourself, with someone else who might have a different view, I think it's a very, very healthy thing to do. And it helps de-risk the investment process.
Absolutely. So from a personal perspective, how do you do that? Like, are you specifically seeking out that opposing view? Do you like when you're looking at a company or the copper market or whatever? Are you specifically going out into the on the internet or within your network of friends and associates and saying, hey, like, what is the antithesis or the anti-bullish thesis to copper or to any company you're looking at?
Yes. I mean, copper is a little bit tough because it is difficult to find anybody at this point in time that, which is also scary. When everybody's agreeing with you, you actually have to, but we haven't seen that expressed in equity prices or the copper price. So even though everybody's agreeing, they're not acting. Look, I'll speak to my network, to people technical people or someone who I might know that has visited a project and I've got a particular view. I want to hear their view. I try again. It comes back to, I think, educating yourself, and also you see this with management teams and boards. Is often everybody's focused on the upside and not what is our downside risk. And coming from the buy side and working for the fund that I did, there was a huge amount of intellectual rigor into the investment decision making process. Very detailed financial models, tire kicking. So there's lots of robust discussion about taking a position in the name. And so you are constantly forced to defend your thesis. And so I think that discipline has helped to some degree because I have that internal dialogue with myself when I'm investing in something. And again, I am always thinking, so for example, some companies, what we tend to see as a pattern of behavior is it's a drill play and everybody gets enormously excited and the share price moves up and the unknown is infinite. And then they come out with a resource estimate and it generally disappoints and the share price falls off. So that pattern, that happens more often than not. So for example, I will probably generally sell before that because I think it's very hard to exceed people's expectations when they think the upside is infinite. So I think what I try and do, I think that there's relatively predictable patterns of behavior that occur in our sector and try to manage my investing around those as well.
You're a non-executive chairman of Hot Chili and an independent director of Bravo Mining. Can you tell us a little bit more about each company and why you've decided to be a part of their team?
Sure. So Bravo Mining is the first company that I've been involved in helping, I suppose, build. So I was a founding director and I was approached to become a director of that company by the chairman and CEO because Luis Azevedo, I knew him from a previous life, Brazilian national. He'd gotten a hold of an amazing asset from Vale. Vale's going through this divestiture process. Look, everybody says they have a tier one asset. Nobody does. Well, very few people do. They're an end member asset. But it's definitely got the very strong probability of becoming one. And so as a PGM asset plus nickel in the Carajás of Brazil. And so a country I'm familiar with, commodity that I probably complex that I'm less familiar with than say copper and gold and zinc and uranium. But I've taken a particular viewpoint on PGMs. But for me, when I look at investing in something, number one, people, it's the most important ingredient. People will say project. I don't agree. I think you can have a mediocre management team destroy value in a good project, and then a great management team extract enormous value out of a mediocre project. So for me, it had the right people. To be successful in Brazil, you need to have Brazilians who understand how to work in the country at all levels of the company. And often when there's failures in a country, people blame the country and not their management of their business in that country. So it ticked that box. It ticked the asset box. It's an unbelievable location. I've never seen anything like it. You leave Rio, you're on site by 1 p.m. It's in the Amazon of Brazil, but it was deforested 40 years ago, so you're not cutting down Amazon trees. There's no indigenous population proximal to the project. There's no people living on the project. There's a very skilled labour force an hour and a half drive away. So all of these soft issues that become vitally important as you go through the development cycle, it was very de-risked from those. And so when Luis asked if I wanted to become involved in it, I went, yes. And so I suppose what I brought to the table was an understanding of the capital markets complex and some very good relationships with institutional investors. And so we really managed we're very strategic in the way that we manage the going public process. So we positioned Key people in the private rounds, got some very good institutional investors. When we went public last year, it was in a very, very difficult time. It was mid-July last year. I don't think anybody thought we'd get the financing done, but we did. And so BlackRock are 9.9% investors, Tembo around 9.5%, and Franklin and RCF within their opportunities fund are very sizable investors. And so we have, I suppose, that tick of credibility with globally renowned resource investors taking a position in the company in very material position. And to me, it's somewhat almost the perfect story, because there's a existing historic resource estimate there that's substantial in size, and Vale discovered it and patent drilled it. That's all they did. And then it went into hiatus for 20 years. And so really our job has been a little bit like hitting fish in a barrel. So infill drilling. So 25,500 meters, 25,500 meters of phase one drilling, which is infill, which is confirmed the drilling done by Vale. And very excitingly, and everybody's enthused about this, we intersected massive sulfides. And so nobody thought that there was potential for massive sulfides in the deposit. Well, our president thought that, but Vale certainly didn't. And so it opens up this geological possibilities. Well, is there a massive sulfide nickel plus minus copper deposit there as well? And so people are excited by that. So it's in that excitement drilling phase. Resource estimate will be out later this year. And back to that risk around resource estimates, what we want to demonstrate as that resource estimate comes out is that we've got a huge amount of potential for growth. So we've only infilled to 150 meters, which was Vale's drilling depth. We know the deposit continues. There are two drill holes down to 300 meters that end in mineralization. And so our job is to basically show how big this thing can be. So it's been a great success story. We IPO'd at $1.75 and it's trading at around $3.30, $3.35. Lots of support, very, very tightly held by management and board and our large institutional investors. And we're trying to demonstrate to the market that we've got capital allocation discipline, that we're going to do things the right way. And this is something I talk about quite a lot. Trust is the rarest commodity in our business. And I think management teams that can engender trust with their investing base, you tend to get a trust premium, because very few companies can do that well. And so it's been a great and exciting adventure to date. And if the geology gods are looking down upon us fondly, that will continue. And then Hot Chili, which will be we've just announced that we'll be changing the name, because the name on the subject of political correctness, it's caused some debate. The Chileans love it, but not necessarily everybody else does. So Hot Chili, which is going to become Costa Copper, it is a bit of a different story. It's been around for quite a long time, plus 10 years. But what attracted me to it, again, it's got some interesting similarities to Bravo. Number one, copper. Obviously, I'm very favorably disposed towards copper. It has a management team. Their asset is in Chile, in coastal low elevation Chile. And again, it has a management team that has the ingredients that Bravo has. So Chilean expertise, a real commitment to the country and their asset base. The management team went through the downturn of the last cycle and managed to come out of the other side of that with a better project, having de-risked it. And I think it takes an enormous amount of grit to survive through the bad times and then come out the other side. And they've also serially de-risked the project. So again, I think this is unusual in our sector for a junior team to take a multi-year view on how to de-risk elements of their project. So they spent 7 years obtaining a seawater extraction license. So the biggest risk in Chile is water. It's a exogenous risk. If you don't have it, you don't have a project. Their mineralization is amenable to water, seawater. In fact, it has higher recoveries with seawater. So they have a water extraction license. They have a very large resource base. It's got the potential to be a 100,000 tonne per year producer. It is in low elevation Chile. It's very accessible. There's power all over the place. It can be theoretically fully powered by renewables, because Chile has de-risked its power situation enormously. It's got the water. It's got very, very good social relations, Chileans on the board and in the management team. So all of those things, it's got a lot of parallels to Bravo, attracted me to that. And on the subject of value, it's deeply undervalued. And there's a reason for that. Its main board listing is in Australia. And Australia Australians can be somewhat parochial in their investment process. They love it if it's in Australia or certain other countries, but if it isn't, maybe they're less keen, and they're not necessarily attracted to the bigger projects, the bulks that have a higher capex price tag associated with it. So it's natural exchanges in North America. So the market cap on a good day is 140 million. Its peers are all trading between 400, 500 million. And so there was this automatic re-rate that should occur just by it got a secondary listing in Canada on the TSXV before I joined the board. And for me, the fix for this is it's promotion. It's making the market aware of the fantastic job this management team has done in executing and delivering, of advancing these projects. They attracted Glencore, and there's been mixed reactions to Glencore's investment, but Glencore are a substantial investor in the company, hovering around 9.3%. They have anti-dilution rights. They have offtake rights, but those offtake rights only have the offtake for 60% of the production at benchmark pricing, and only for the first 8 years of the life of mine. If they go below 7.5%, they lose those offtake rights. And so maybe the typical bear hug that you would see with Glencore hasn't happened in this particular situation. And the management team negotiated that before I joined the board, and I think did an exceptional job. So you've got also major credibility, if you want to call it that, some other large founding shareholders that are sizable positions. And it's a project that the trigger can be pulled on pretty quickly if you decide to go down that development pathway. And what we're focused on now is we've recently consolidated around the main resource, the bulk of the resource, additional land, where there's known porphyry copper gold mineralization. And so getting some great drill results on that. And then we'll be aiming to come out with a PEA mid-year. And so that one in some ways a bit more advanced than Bravo, but a lot of the same ingredients for me, with people, place, project quality, right commodity.
Right. And so actually this brings me to another question, actually going back to what we were talking about earlier at the beginning of the conversation. Jurisdictional risk, obviously Chile has been in the headlines the last couple of years. And, me personally, there's a few things that happened that kind of made me take a step back. But I think you brought up a good point in terms of, there's risk everywhere. North America has its own risk, and South America has its own types of risk. So for you, is the value proposition what allows you to take on some of that jurisdictional risk, whether it's there or not, in particular Chile, but just a general question, is the valuation which allows you to maybe take on more perceived risk?
Absolutely. The deeper the undervaluation, the more risk that you're willing to take on. I think Chile, there's a bit of a lack of understanding. Obviously, there was a huge amount of noise and a lot of concern by general market participants about what was going on in Chile. But I think what's happened politically has demonstrated that there is not support for obviously changing the constitution in the direction that it was that the government was pushing towards, and also really changing the fiscal structure, because I think a realization that you need foreign investment to advance and both expansions and new mines, but also, Chile is the largest copper producer in the world. So it really does, it forms a key component of future copper supply. So I'd say that political risk has materially decreased in Chile. I think there's always tax risk. But interestingly enough, both in Chile and Bravo, to change mining taxes, it has to go through government. You can't just arbitrarily change. It has to be voted on at Congress. And in Australia, that's not the case. The Queensland government decided to whack on a maximum 40% royalty to all coal producers, which is somewhat ironic given that Australia still produces 55% of its electricity from coal. And so you cannot do that in Chile and in Brazil, for example. So I would say there's a little bit more checks and balances to arbitrarily running around changing taxes and royalties in the way that you've seen in countries like Australia.
Right. Well, another good example is in Canada. The Canadian government put on with this, well, it was before net zero, but they strapped on no coal production in Alberta past 2030, I think. And it was on the Jinsey coal mine, and it cost Altius Minerals, I think it was $200 million or something like that, crazy amount in future royalty revenues. And they've gone to court over that. But it's another example of what you just brought up, like how this kind of hides from investors' purview in terms of how they look at your different jurisdictions, but it's definitely there.
Well, it's this weird thing that's going on right now with this move to net zero is we are voluntarily making our cost of living exceptionally expensive. And the people that's hurting the most, it's people who are working class or who don't have a strong economic background to deal with the fact that their energy costs are skyrocketing. Maybe less so in Canada because a lot of Canadian power is hydro, but in other parts of the world where you've got a double, tripling of your energy costs, and that's your fundamental ability to live your life. And I think it's crazy what's going on now with this. And I think maybe the average person is going to wake up and go, this move to net zero, we're not necessarily thinking about it or executing in the right way. Energy matters, and cheap energy matters. And so if we're choosing to not have cheap energy, the knock-on effects of that are they're material.
Absolutely. Honestly, and that's, for me personally, that's one of the negatives that I wonder if is kind of hiding out there, is whether cost becomes one of those capping factors moving forward for commodities. Like, to have a bullish thesis on commodities, you it only goes so where we were talking about before, the high prices are the cure for high prices. And or at least I wonder what that looks like moving forward, because there's every reason to see metal prices higher in the future. But you wonder, who's going to be able to spend the money, or where that money's going to come from to build the roads, build the whatever.
Well, ironically, with the move to net zero and the increase in consumption of commodities like copper and like lithium, all of these energy transition metals, the amount of metal required to even get there is extreme. And so at some point, governments need to make a choice. And I think sometimes we're conflating climate change with being environmentally aware with obviously, you want to take an approach where you're impacting the environment the least amount that you can, but it also needs to be contextualized into the needs of our society. And we in the West are obsessing about it and sort of willing to negatively impact our ability to perform in a global context. And you have China and India and other countries going, well, we don't care. And so I think it's going to be interesting to see how that plays out. And I think how it will play out, it'll play out with voters. Because voters understand their energy bills. Voters understand the fact that costs of most of their inputs has been massive inflation. And when they start to connect the dots, so you have governments making these decisions that have these knock-on effects that are really negative and really, really hurt some segments of our population, I think that response is expressed in voting.
Right. I guess the only problem is that it's reactive. It has to go first, which is good and bad.
Well, that means that, again, circling back to, I say this quite a lot and everybody thinks I'm joking. I am, but I'm not. The way to get everybody to understand how important mining is every mining company in the world should just stop. Stop. Stop for a month. And everybody would understand very, very quickly. And then we wouldn't have to fight this ideological battle. And so, again, I think it's, for the first time, though, we are seeing governments talk positively about mining. And we are seeing younger people, because they understand that energy transition requires commodities. So what the talk about net zero and energy transition has done to us is help us maybe message ourselves a little bit better. But we need to definitely be still pounding that point home.
Right. One other question. In terms of resource estimates, I've heard it in two different kind of contexts. You've got the Great Bear model where, they really kept the market, especially those that are sort of ignorant to how these things are done or how to even calculate a mineral resource estimate, keep them in the dark, and really worked in their favor potentially because the valuation went to enormous levels. Then you have other companies that it's a much more practical approach, and we're going to do a resource estimate, then we're going to do a PEA, and then we're going to move up that scale towards production. So my question is a resource estimate a limiting factor, or is it only in the gold market where you can go without a resource estimate and still attract attention?
Oh, look, PhD theses should be written on Great Bear. They did an unbelievably superb job of executing on the marketing side. Great discovery, obviously. Very, very hefty valuation. I think they probably realized, we've seen with Kinross's resource estimate that resource estimate, if it had come out similar to that, it would have probably disappointed. They sold at the perfect time. hats off to them. They created enormous value for their shareholders. And I know, speaking to some of the management team, that's a very stroppy shareholders saying you sold too early, but they did a superb job. I would say releasing a resource estimate is almost always a negative. And that's because your resource estimate has to surprise on the upside. So it can be a positive, but it has to, at the minimum, meet expectations. And I think the Great Bear management team understood that expectations were so high that would have been a harmful event for them. Unfortunately, I was a Kinross shareholder, and I thought that Kinross had learned their lesson after Tacius and acquiring Aurelian. Turns out they hadn't. So, yes, I woke up when that happened and went, oh my God, I can't believe you guys did that. And it was crazy. I use it when I talk about reasons why share prices move, because their share price had tracked with basically no news, was outperforming the GDXJ by 40% before the premium takeover. And that was because Barrick was acquiring ground contiguous with Great Bear. And so it had this takeover anticipation premium built into the share price. And then Kinross came and paid a premium on that. Anyway, it wasn't great to be a Kinross shareholder that day. Let's just say that.
Oh yeah. Well, there's in my experience, there's numerous things that come up that are always a learning experience, and it's constant stuff. Nicole,
I know.
Nikki, it's been an absolute pleasure. Thank you very much for coming on the show. We really appreciate it.
Oh, thank you very much for having me.